Broadcom just dropped its Q2 earnings and the numbers are impressive. From record-breaking revenue fueled by AI demand to bold forecasts that could reshape the tech landscape. This report marks a turning point, not just for Broadcom, but for the AI industry. In this video, we'll break down Broadcom's latest performance, what's driving their growth, and why investors and analysts are paying close attention. Let's dive in. So, why is Broadcom doing so well in the AI space? For starters, Broadcom builds the high-performance infrastructure that powers AI at scale. Think custom accelerators, AI networking chips, and ASICs used by hyperscalers like Google, Meta, and Microsoft. In fact, their Tomahawk 6 chip, just launched this quarter, doubles networking performance to 1.6 terabits per second, a huge deal for AI data centers handling massive workloads. In the second quarter alone, Broadcom's AI-related revenue hit $4.4 billion, up 46% year over year. That's nearly 30% of total company revenue, and it's expected to grow to $5.1 billion next quarter. AI isn't just a trend for Broadcom, it's a core engine of growth. But the real power play? Their software business. After acquiring VMware, Broadcom now runs a diversified portfolio in enterprise infrastructure, cloud management, and cybersecurity. In the second quarter, their software division brought in $6.6 billion, which is about 44% of total revenue. Even more impressive, this segment runs at gross margins above 75%, far higher than their semiconductor margins. That means consistent, high-margin cash flow that balances the cyclical nature of hardware. Broadcom's Q2 2025 results weren't just strong, they were strategically impressive, especially for a company straddling both hardware and software in this AI boom. Now let's break down the numbers. Total revenue came in at $15 billion, up 20% year over year. That's acceleration from last quarter and speaks to both AI strength and the growing contribution from VMware. On the semiconductor side, revenue reached $8.4 billion, up 17% year over year. Notably, this is faster growth than in Q1, where it was up just 11%. The momentum is clearly picking up. Now here's the headline. $4.4 billion of that was AI semiconductor revenue, up a huge 46%. This marks 9 straight quarters of growth in AI chips. AI networking made up 40% of AI revenue this quarter and grew over 70% year over year. That's high-octane growth driven by demand for faster, more scalable data center connectivity. Meanwhile, non-AI semiconductor sales, things like industrial chips and wireless, brought in about $4 billion, which was actually down 5% from a year ago. It's clear that AI is offsetting weakness in more cyclical areas. On the software side, Broadcom pulled in $6.6 billion, up 25% year over year. That's not just growth, that's momentum, especially considering it beat guidance. Why? Because enterprises are moving aggressively from perpetual vSphere licenses to VCF, the subscription model Broadcom is pushing hard. And when we talk about profitability, Broadcom's margins are nothing short of elite. The total gross margin came in at 79.4%. That's among the highest in the industry. The semiconductor segment delivered a 69% gross margin, up 140 basis points year over year, despite all the investment in custom AI accelerators. But the real standout is software. The infrastructure software business hit a 93% gross margin, up from 88% a year ago, showing just how efficient and scalable that VMware transition is becoming. On the expense side, Broadcom spent $1.5 billion on R&D, mostly fueling AI chip innovation. Semiconductor operating expenses rose 12%, but that's expected as they ramp up XPU development. And Broadcom continues to be a cash machine, generating $6.4 billion in free cash flow, which was 43% of total revenue. They used that to return value to shareholders with $2.8 billion in dividends and $4.2 billion in share buybacks. Looking ahead to the third quarter, Broadcom is expecting the momentum to continue, and the guidance reflects real confidence. Total revenue is forecast at $15.8 billion, which would be a 21% increase year over year. Semiconductor revenue is expected to hit $9.1 billion. And most notably, AI chip revenue is projected at $5.1 billion. That's 60% year-over-year growth and would mark the 10th consecutive quarter of AI revenue expansion. On the software side, they're guiding to $6.7 billion, up from last quarter, continuing that upward trend as more enterprises shift to subscriptions. In other words, Broadcom sees continued strength in both hardware and software, and they're executing on both fronts. Gross margin is expected to dip 130 basis points in Q3 due to more XPUs in the mix, which carry lower margins. But again, that just shows how fast AI is growing. So in summary, Broadcom's Q2 wasn't just about growth, it was about the right kind of growth. High value, high margin, and increasingly recurring through software. Looking ahead, Broadcom isn't just riding an AI wave, they're engineering it. Management gave investors something rare during the Q2 call, multi-year clarity on the AI revenue pipeline, with visibility extending into fiscal 2026. According to the company, demand is solid not only for AI training chips, but also for inference, which is critical because it means customers are now monetizing AI platforms at scale, not just building them. Broadcom's AI chip strategy really comes down to two main pillars. First, there's networking, where they already lead the market with products like Tomahawk 6. Their latest chip just launched this quarter. It doubles switching capacity to 1.6 terabits per second, which is crucial when you're training massive AI models that need to move huge amounts of data. Then there's the second pillar, custom AI accelerators, also called XPUs. These are purpose-built chips designed specifically for companies like Google and Meta, who use them to power AI inference. Basically, the deployment side of AI, not just the training. And here's the big shift. Management expects that by fiscal 2026, XPUs will actually surpass networking as the main source of AI chip revenue. In fact, they expect networking's share of AI revenue to drop below 30% by then. Not because networking is slowing, but because XPUs are scaling even faster. Broadcom admitted XPUs have slightly lower margins, clarified by CFO Kirsten Spears, but the volume opportunity and customer lock-in make it a long-term win. And when it came to questions about how challenging these AI products really are to build, Broadcom's CEO didn't downplay it. He acknowledged that networking is incredibly complex, but also made it clear that XPUs aren't any easier. Both areas require deep technical expertise and custom engineering to meet the demands of hyperscalers. That sums it up well. Broadcom is playing on both ends of the AI infrastructure stack, and doing it profitably. On the software side, Broadcom's integration of VMware is actually going better than expected. They've been transitioning customers away from those old one-time perpetual licenses and moving them onto the VCF subscription model, and that shift is already starting to pay off. Right now, more than 87% of Broadcom's top 10,000 enterprise customers have already adopted VCF. Annual recurring revenue is growing at a double-digit pace, and Hock Tan mentioned the full transition will likely take another 12 to 18 months to complete. But the momentum is clearly there. This shift means more predictable, high-margin recurring revenue, which supports Broadcom's free cash flow generation and shareholder returns. And Broadcom has made its capital priorities crystal clear. First, pay dividends, then reduce VMware, acquisition debt, and buy back shares when the price is right. They're not betting on future maybes. Management said they'll only include new prospects in forecasts when revenue conversion is confirmed. This cautious tone might sound conservative, but it's part of what makes Broadcom a disciplined operator. So after going through Broadcom's Q2 results and their strategy moving forward, one thing is clear. Broadcom isn't just riding the AI wave, it's building the infrastructure behind it. From custom AI accelerators and high-speed networking chips to mission-critical enterprise software, Broadcom has positioned itself right at the heart of the AI ecosystem. It's rare to see a company that can execute so well across both semiconductors and software, and do it with margins this strong and cash flow this consistent. Sure, we might see some short-term margin pressure or market volatility, but those pullbacks are opportunities, not red flags. With solid leadership, deep customer relationships, and long-term visibility into AI demand, Broadcom looks built for the next decade, not just the next quarter. Personally, I think this is one of the most strategically positioned AI infrastructure plays out there, and every dip should be bought. Do you think Broadcom is leading the AI race, or is someone else flying under the radar? If this breakdown was helpful, give it a like, subscribe for more earnings breakdowns, and drop a comment.